Hello and welcome everybody to this XTB video. My name is Walid Kudmani, Chief Market Analyst for XTB. And thank you for being here with us today. At the beginning of this week, we're going to be covering what the main events are of this week, what to keep an eye on, a quick recap of what happened last week, and some of the things to keep an eye on as far as markets are concerned, and some of the potential movers this week as well. So today's theme and today's title is Rates Rise, Markets on the Verge of a Panic. So we've already seen this at the start of this week. Markets are starting the week a little bit lower across asset classes. Some are rebounding slightly, but let's take a look at some of the major events that happened at the end of the last week and that could be impacting markets throughout this week. As always, we start with the disclaimer and risk warning. This presentation is provided for general information and marketing purposes only. I'll give you a couple of seconds to read through this. Pause the video if you'd like, and of course, go through it. If you have any questions relating to anything we covered today in this video, please leave them below in the comments, and we will try to address them in the next video, or the next live webinar, which we will be doing shortly, of course. So first thing to keep an eye on is banks, which have been a key topic of discussion. Central banks push rates up, markets panic. So what did we see happen last week? We saw the Fed raise interest rates by 50 basis points in line with the market expectations, even though there was some potential expectations of a 75-point increase. The Fed indicates two similar rate hikes in June and July. So one of the main themes we saw in the past was potential for each meeting having a subsequent increase in rates. As far as we're concerned at the moment, it seems like that is the case, at least for the next couple of months. The market had previously seen 4 rate hikes by 50 basis points. Powell rules out at the moment a 75 basis point hike at this point, but does not rule out similar approach to fighting inflation as Paul Volcker, although this is not the base scenario. So it is a potential scenario, but not the standard base scenario at the moment. The balance sheet reduction, which is another key topic which has been addressed by the central banks, begins June 1. So that is going to be something that will be playing into the markets at the beginning of June. Markets saw the possibility of an earlier start, but this is not a late start by any means at the same time. The reduction will be at 47.5 billion, 30 bonds, and 17.5 MBS. An increase to 95 billion after 3 months, 60 bonds and 35 MBS, more or less as expected. So I think it was expected slightly higher, but we were getting it generally in that same range. The Fed was not more hawkish, meeting market expectations, leading to profit taking. It is worth to remember that the pace of tightening is powerful, which may have been one of the reasons for the only temporary improvement in sentiment after the collapse on Thursday, which carried over into Friday, and which we are seeing as well in the Asian markets starting this week. The market will be asking itself whether the Fed will be able to make a soft landing in the face of slowing US consumption and a strong slowdown in China. So, what are the market expectations moving forward? Market expectations for rates are declining. The market still sees two full 50 basis points increases. So if I'm not mistaken as well, by the end of the year, generally speaking, the expectations were around for an interest rate of 2.5% from the US Central Bank. We saw some deviation from the European Central Bank for several causes, including the conflict, which you will be able to see in a video upcoming on the inflation and causes of inflation and how commodities are relating to that, which I've recorded. So keep an eye out for that as well. And again, if you have any questions, feel free to leave them in the comments. September expectations are revised down though now. So rather than 50 basis points each meeting, we have July and June for 50, and then September's are back down. Powell indicates that after 50s, Fed will raise rates by 25s. So that's what's going to be potentially coming. And the year-end expectations are no longer 3%, but about 2.75% or 2.5%, as I mentioned. Powell expects neutral rate to be between 2 and 3%. So that is the target that we will be aiming for. Again, an interesting thing to keep an eye on will be towards the end of the year, we have the midterm elections in the US, which are going to be a key factor in the central bank policy, because an economy in decline and in recession potentially could be very negative for the current President Biden. And I'm sure there will be something that will be done to avoid that at some level. So let's take a look at the 2000 dot-com bubble. This is the US 500, so the S&P 500. We can see here, this is on the weekly chart, and we can see obviously heading down from there towards 2003. So mid-90s to 2003. And we saw the Fed hasn't raised rates by 50 points since May 2000, when the hike was also fairly well received. But trouble was yet to come, as we notice here. persisted for several years after that. So we saw a decline of several years in the US stock market after the last 50 basis points raise. However, the situation was slightly different, quite different. We were coming off at this time of a unprecedented fiscal and monetary policy adjustment by the central banks. Now Powell is communicating a 150 basis points move in 3 months. The previous time we had this kind of situation was April 1982. So again, please be aware this presentation or this data presented is past performance and does not reflect future, but it is important to keep an eye out for the past to see how markets may in the past have reacted and then how they may react once again. So the Bank of England, though, on the other hand, is having some negative expectations. If you follow any data coming out from the UK, you'll have noticed rising inflation, record inflation, rising prices. The pound is struggling. A lot of negative impact scenarios are happening in the UK, particularly with energy crisis as well. The Bank of England presents gloomy scenario for the economic growth. Q2 momentum to deliver growth of 3.2%. By the end of the year, GDP is expected to have already declined, with a strong likelihood that the picture will be extended into 2023 and 2024, even at 1%. So we can see the potential expectation for the next few years of a decline in the economy of the UK. Again, the UK, don't forget, coming out of Brexit, which is having a significant impact on the economy. Then we had COVID, and now at the moment with the conflict, Russia-Ukraine conflict, once again having a lot of an impact, or a very, very large impact on the prices in the UK. House prices reaching record levels. Really, a lot of indicators indicating slowdown in the economy because of the fact that the consumer will not be able to keep up. Compare that with consistent increases by the central bank of interest rates, just making it even more difficult to get to capital. It's going to be, and liquidity in the markets is going to be more and more challenging for the economy. Inflation is expected to reach 10%, 6% forecast in February by the end of this year, and not return to target until the end of 2023, so another year and a half from now. And the bank sees a good chance of an increase in the unemployment rate in the second half of this year. Again, troubling statistics from the Bank of England. We can see them here thanks to the statistics provided by the Bank of England. The UK rate expectations curve shifted about 100 basis points since last meeting at peak. So we can see some potential expectations here. We see the US, UK, and Euro area. The Euro area has a slightly different approach at the moment because, generally speaking, the Euro area, the ECB, let's say, follows the Federal Reserve quite closely. At the moment, though, we are seeing a deviation because how much more the European Union and the Euro area as a whole is being impacted by the conflict for geographical reasons, of course, and ties to their energy market in Russia. While the US is an energy exporter, they are less tied to the economy in Europe, definitely less tied to the economy in Russia. So less direct impacts, trying to move forward. Plus, it seems as if the Federal Reserve is much more tied to politics than the ECB is tied to politics, let's say, in that aspect, because, of course, the European Central Bank is tied to so many different countries. Market expectations for rates unchanged despite BOE's negative outlook. So you would expect some sort of an adjustment where, as I mentioned, a lot of negative indicators coming out moving forward. You would expect potential negative or a reaction by the central bank trying to mitigate that, but we are not seeing some of that. And looking at dismal consumer sentiment, BOE forecasts massive fall in real consumer income. Despite we saw an increase in employment after the pandemic, we saw a return into the markets, especially at the start after the post-pandemic recovery started. But now consumers are struggling, and we are seeing the impacts of that both in actual data and then as sentiment as well. So we can take a look at some rates across the world. Last week we had many central bank decisions. Poland increasing their rate from 4.5 to 5.25. Brazil 1%, 11.75 to 12.75. Chile 7 to 8.25, and Czech Republic 5 to 5.75. Most emerging markets maintain deeply negative real rates, and this puts upward pressure on the further rate hikes. So potential for more and more increases in rates across the world, which is a trend we are seeing across the world. The oil market, which again, if you care about more details, and I suggest you watch the video that's coming out and you can find it on the XTB UK YouTube channel on inflation and commodities, which I've recorded, and it goes much more in depth into the impact of inflation on commodity prices and vice versa, which one is impacting which. So for a more in-depth guide on that, you can take a look at that video. And of course, if you have any questions, any sort of comments, please leave them below, and we'll try to address them in the next video or live webinar. So oil holds up thanks to supply pressure. Bloomberg indicates that the demand effect on the increase in oil prices since the beginning of the year is melting away. The EU is getting closer to an agreement of imposing an embargo on oil, embargo on imports of Russian oil. So that was something that was being debated for a very long time, although it was very, very hard for the European Union, particularly some of the more dependent countries, to find an alternative. Some of them are moving away, like Germany. Italy somehow are managing to kind of address that issue. I covered that in the previous video, how difficult it would have been, but we are moving in that direction. Oil imports to be suspended in 6 months' time. Fuel imports by the end of the year. Slovakia, Hungary, and the Czech Republic are to give up Russian oil only in 2024. So these are quite long-term things, but they are having an impact on potentially the markets as well. Here we can see change in oil price due to demand. This is thanks to Bloomberg. Change in oil price due to supply, and overall change in oil price the 1st of January 2022, as you can see. China, a powerful threat to demand, so that is having a counter effect on the price of oil, stabilizing it slightly at the moment. The massive depreciation of the yuan shows the huge problem facing the Chinese economy with the lockdowns. Typically, after a strong depreciation of the yuan, we have always seen a correction in the oil market within a few months at most. Again, this is past data, it does not refer to the future, but it is important to keep an eye out past data, as it can be somewhat of an informative thing to keep in mind. On the other hand, demand for oil in China from the peak to the local bottom has never recorded a decline of more than 1.2 million barrels per day, except for the pandemic, when the decline was 3.2 million barrels. But it was recovered in 3 months. So China was the first impacted by the pandemic. They completely had a no-tolerance policy on COVID, locked down very strictly, but then was one of the first countries to recover. At the moment, we are seeing it be one of the only countries, if not the only country, going into that no-COVID policy, where they are absolutely locking down several sectors of their economy, several sections of their country, including the financial hub of Shanghai and other production hubs across the country. So those are definitely being, how important China is from an import point of view as far as raw materials and commodities is having a significant impact potentially on the price of oil. And you can see that over here on the Bloomberg chart as well. And another thing to keep an eye on this week is earnings season continues. We have seen a lot of the mega cap companies already announce their earnings. At the beginning, we had that shock with Netflix dropping 40% after a significantly bad outlook, considering several things they're doing, as well as far as their policy, increasing rates and all of that. So we are seeing a lot of shockers in this earnings season. With a struggling stock market at the moment, it's going to be very, very important to keep an eye on the next earnings. So let's take a look at what's happening. Last week's summary: Advanced Micro Devices, AMD, revenue up 71% year on year in Q1 22. The company remains optimistic for the rest of the year and doesn't see much negative impact from weakening PC demand. As far as the post-pandemic boom, of course, people now are going back out a little bit more. So we saw a huge boom in PCs, consoles, TVs, any sort of entertainment, electronic devices throughout the pandemic as people were locked down. Now the trend is shifting slightly, but still they expect over 60% revenue growth for the full year of 2022. Lyft, the company reported an unexpected profit. However, the stock price crashed after the company reported that it is starting to have trouble attracting new drivers, which means it will have to crank up its incentive system. That in turn means rising costs. Again, though, positive results. Uber technology, so Uber, the collapse in Lyft's stock price negatively impacted Uber's valuation, causing the company to make a surprising move and accelerate the release of its Q1 2022 results by several hours. Revenues grew by over 130% and were higher than expected, while the loss was smaller than expected. Moderna, the vaccine and other pharmaceutical company manufacturer, tripled their revenue compared to Q1 2021. Results significantly better than expectations, thanks to strong vaccine sales at COVID. However, the company warns that the U.S. government may not place a new order for booster doses, which could impact their revenues going forward. Virgin Galactic, the company reported a net loss that was 28% lower than a year ago. Revenues came in better than expected. However, the supply chain and workforce issues, due to supply chains and workforce, Virgin decided to delay launch of commercial spaceflight until Q1 2023, previously scheduled for Q4 2022. So delayed by 1 quarter. However, it's still a key event to keep an eye on. Let's take a look at the calendar for this week. As you can see, Monday, quite a few. You can check that out in the economic calendar. Of course, we publish these every day, but this is a good chart to give an indication of when the when the earnings are being released. Wall Street earnings season slowly comes to an end. A large number of publications from Europe in the coming weeks, so European earnings season is also something to keep an eye on. However, it is worth remembering that in Europe, it is popular to show preliminary results, so the publication of full reports, dates in the table opposite, these ones, may not have as big an impact as the stock value on the stock valuation. And also, one more thing is US inflation in focus this week. Let's take a look at some of the data that's coming out. Reports for Q1 2022 of the following listed companies. You can see these: Palantir, Tyson Foods, Electronic Arts, Sony. I'm just going to leave these here. You can pause and take a look. And some macroeconomic data across the days: building permits in Canada, retail sales and employment for March, industrial production for March in Italy, economic and consumer sentiment in Germany, CPI inflation in the US, Fed budget balance important, OPEC monthly report. OPEC has been a topic of discussion, so keep an eye for that one as well. And then May 13th, Friday, CPI inflation from France and other countries, EU and the US, and inflation expectations as well, consumer sentiment. So that is all for today's video. Thank you very much for being here with us. My name is Walid Kudmani, Chief Market Analyst. If you had any questions or anything that was unclear, please leave them below in the comments. We'll try to address them in the next video. And I'll see everybody at the next one. Thank you very much. Good luck with your trading.